Welcome everyone to the Altcoin Insider channel. Today we are doing a deep dive into Stellar XLM. Over the past few weeks, XLM has been forcing the market to look at it not just as a dinosaur coin, but as a project actively developing its DeFi layer and infrastructure around Soroban. Let's agree right away. We don't read tea leaves here. We operate like professional traders using market structure, key levels, confirmations, and predefined invalidation points. At the end of the video, I'll give you a clear trading plan, where the bulls absolutely must hold the price, where the bears take control, and which levels will trigger massive upside acceleration. To get the most out of this video, keep 3 time frames in your head. The weekly for macro context, the daily for market structure, and the 4H, 1H, for entry triggers and liquidity. Let's go. Fundamentals, on-chain, and why it matters. First up, the recent massive movement of 2.7 billion XLM. Many retail investors saw this and panicked, expecting a massive dump. But on-chain analysis reveals this was actually a liquidity reclassification and restructuring by the Stellar Development Foundation, not a market sell-off. This is a crucial takeaway. The market usually reacts to fear rather than actual facts. Second, the ecosystem has been recording high on-chain activity despite weak price action, alongside growing discussions about its expanding DeFi sector, including liquidity protocols like Blend. This is a classic setup where fundamental metrics begin to improve way before the chart shows a clear uptrend. Third, the network recently activated Protocol v19.6, a major upgrade aimed at boosting performance and reliability. Additionally, the Freighter wallet got a massive update, reducing initial load times by 63%, down to just 1.27 seconds. For a regular user, this isn't just pretty marketing, it's a real reduction of friction when interacting with dApps. Here is the key point. Strong fundamentals and UX improvements don't create tank pumps overnight on their own, but they drastically increase the probability that any future bullish impulse will be backed by real demand, not just speculation. So, let's look at the charts. Deep technical analysis. Structure, levels, indicators. Where we are right now. Looking at the current picture, XLM is tightly squeezed in a range between roughly 0.142 and 0.154. When the price compresses like this, most retail traders lose money not because they guessed the wrong direction, but because they trade the middle of the chop without waiting for a trigger. The best way to think about this, the market pays the patient and punishes the restless right now. Our job is to identify the range boundaries, see who is defending the levels, and wait for confirmation. Moving averages. Trading into the wind. The moving average picture is undeniably bearish at the moment. The price is trading below the 60-day SMA around 0.196 and significantly below the 200-day SMA around 0.285. This means any long position taken right now is not a trend trade. It's either a counter trend play or an early reversal catch, which requires incredibly strict risk discipline. The practical takeaway, as long as the price is below these key moving averages, we don't need to be heroes. We either scalp bounces from support or wait for the market to prove its strength with a breakout, a successful retest, and a surge in volume. RSI, exhaustion versus strength. The relative strength index RSI is currently hovering in the 32-42 range, meaning we are exiting the extreme oversold territory and moving into a more neutral zone. This isn't an immediate buy signal, but it does indicate that the aggressive selling pressure might be running out of steam. As I always say, the RSI doesn't predict price, it acts as the market's thermometer. The temperature is dropping, which means the panic is subsiding, but the trend hasn't officially reversed yet. MACD, preparing for the move. Looking at the MACD histogram, The indicator line is in the negative zone, around 0.0108, but the histogram itself is flattening out near the zero line. This kind of compression frequently happens during the squeeze phase right before a volatile move, but by itself, it doesn't tell us which way the break will happen. I wouldn't use a pretty MACD chart as my entry trigger. The real trigger is the combination of a level breakout, a successful retest, and decent volume. Let the MACD be your confirmation, not your primary reason to enter. Fibonacci, the must-hold zone. If we pull the Fibonacci retracement tool, we see a clear cluster of levels, the 50% at 0.1525, the 61.8% at 0.1485, and the 78.6% at 0.1429. The meaning of this block is simplets, the golden pocket decision zone, where bulls are fighting to maintain market structure. As long as the price stays above the 0.142, 0.143 area, bulls still have a chance to defend this base and build a bounce. Losing this zone is basically a regime switch. We shift from accumulation straight to hunting for lower liquidity. Liquidity, price action inside the range, more important than indicators. Now for the most valuable insight that most people miss, how the price behaves inside the range. In this stop 0.14 to W0.154 box, the market usually does one of two things. It hunts the stop losses below support, a fake out wick, quickly reclaims the range, and only then starts pumping. Or, conversely, it taps the support repeatedly, the bounces get weaker and weaker, and eventually the floor collapses. That's why I wouldn't just blindly watch to see if we touched at 0.142. I'd watch the quality of the reaction, the speed of the buy-up, the length of the lower wicks, and most importantly, the candle closes on the 4H and daily timeframes. That is the real language of the market. Scenarios and trading plan. No fluff. Scenario A, bearish, breaking the base. If the 0.142 defense line fails to hold up to the pressure, the next major downside target is the 0.122 level. In this scenario, I absolutely would not try to catch a falling knife. I would wait either for a massive capitulation wick with heavy buy volume or for a brand new accumulation range to form lower down. The tactic here is simple. You either stay in cash and wait, or if you're already in a long position, you must know exactly where your invalidation point is. That is what separates professionals from gamblers. Scenario B. Base case. Holding, but no rocket. This is the most common scenario. Support holds, but the price grinds up in choppy steps because sellers are sitting right above. In this environment, you don't trade on hopium. You trade a plan. You take partial profits at local resistance and re-enter on pullback. Our first upside targets here are the resistance at 0.1573, followed by the 0.17 zone if the bounce gains traction. The logic is simple. Breaking a level is great, but true strength is shown when a level is broken and held on the retest. Scenario C, bullish. Trend activation. Several analysts expect a recovery toward the 0.18, 0.2 area by March if the broader market dynamics align. To me, this is the risk-on scenario. Getting there requires a specific sequence, holding the 0.142, printing a series of higher lows on the 4H chart, and an explosive breakout through immediate resistance. Keep in mind, 0.18, 0.2 is not the final destination. It's a massive liquidity pool where the fiercest battles will happen because trapped buyers will be looking to exit at break-even. If we get there, we need a new plan, not just a hold to the moon mentality. Risk management, what separates traders from viewers. Do not trade the middle of the 0.142, 0.154 range. The risk to reward ratio there is terrible. Only look for longs either on a confirmed reaction off support or after a breakout, retest of resistance. If you cannot accept the stop loss, you are not ready to take the trade. And remember, the market can remain irrational longer than you can remain solvent. Don't argue with the chart, read it. So, wrapping up this XLM deep dive, the 0.142, 0.143 zone is our absolute line of defense, and the 0.142, 0.154 range is our current battlefield. Fundamentally, Stellar is making huge strides. Protocol v19.6 is live, and Freighter has been massively optimized, making the infrastructure vastly better for retail users and DeFi growth. But technically, we are still in a waiting game. The major moving averages are above us, meaning the market demands confirmation, not emotions. If you guys want, in the next video, I can do a dedicated segment on how to read XLM on the 4-hour chart using liquidity and stop hunts, showing you exactly where retail gets trapped, how to tell a fake out from a real breakout, and which candlestick patterns statistically perform best on this specific asset. Thank you so much for watching this deep dive to the end. If you appreciate this level of detail, hit that like button, subscribe to Altcoin Insider, and make sure to ring the bell. Let me know down in the comments, are you currently trading XLM level to level for short-term gains? Or are you accumulating for the cycle, willing to sit through the chop for a potential run to the 0.18, 0.2 recovery zones? I'll see you in the next video.